What I'd like to do today in this video, Stephen, is give the audience an understanding of not just what ROI is, but also what kind of ROI someone should expect from an off-plan property and how to actually calculate good ROI. So let's start at the very beginning. Can you explain what ROI means in the context of investing in off-plan property in Dubai?
So ROI, or as it's known, return on investment, when you're buying an off-plan property, is the amount you can earn or make on what you've actually paid for that property. So whether you pay for it in full, whether you paid the first 30 or 40%, whether you paid 70%, whether you keep it after completion and you pay all the service fees and all the other fees, etc., that you might have to pay for once you've taken handover. You could base it on what you can sell the property for, or you could also take into account any rental that you might receive once the property is finished. You could call that return on investment. I tend to call that rental yield. Return on investment is more often than not the number that you would receive once you sell the property.
Would you consider return on investment a combination of the two? So the rental yield that you've received plus the value of sale?
Definitely. If you're in it for the long term, then yes, the return on investment is based on what you paid for the property, all the fees, all the maintenance fees, service fees and everything. And then you would be a combination of capital growth and rental yield. That would be the total return on investment. But that can only really be you can only really calculate that once you've actually transacted on that property and resold it.
So what are the key components or factors that should be included when calculating the ROI for an off-plan property?
So the immediate one that comes to mind is the payment plan, is how much you've actually paid for that property, any lending costs, finance costs, etc., and any fees that you might have had to pay for that property, whether that be the Dubai Land Department fee, agents' fees, transaction fees, so trustee fees, the transferring the property into your name, what fees you paid, and then you calculate what the return is, how much money you receive for that property when you decide to sell.
What is considered a good return on investment?
Look, that is such a difficult question to answer. What is considered to be a good return on investment? Look, it all depends. It's impossible to tell you. I can tell you that there are people out there who have bought properties a couple of years ago who have doubled their money. I can even give you examples of where they might have tripled their money. And then there are other examples where they might have only made 10 or 15, 20% on their investment. What's considered to be good? That's in your mind as the investor. And that's where your expectations have to be managed by your agent and by your own research. What are your expectations?
How do you manage those expectations? If someone comes with what you would consider to be unrealistic expectations?
Look, I don't have that many people nowadays who are purely looking at capital appreciation or return on investment. They're looking at different factors, which is they want to live in the apartment or the property. They want to rent it out short-term, long-term. They're looking at rental yield more than anything. Most people are looking for an income. I do have this discussion a lot with my investors when they first talk to me, and they tell you, yes, I'm buying this property, and when it's finished, I'm going to resell it. But when they get to the point of receiving the keys and they see how much rent they can receive, their strategy tends to change. You do have some people that they're never interested in renting the property out, and almost everybody talks to me about, yes, I want to sell the property at some point and make a load of money or make a big profit. But when they see the sort of rental returns they can make, then they just hang on to the property. It's annoying for me because I make more money. The more sales I make, the more money I make. So I would love it that people stuck to their original strategy. And as I say, most people say to me at the beginning when they start talking to me, I'm looking at buying to sell. I don't want a tenant in there. But then, as I say, their mind changes when they find out how much rent they're going to get.
So what are the things that could make your property go up in price, therefore giving you a higher return on investment?
So changing in the facilities of the community, so whether that be a new mall, hospital, school, that certainly would affect your the value of your property. If a metro station is in within a very short distance of your property, that would affect things. One of the factors we found for capital appreciation has been there's buildings that have been predominantly purchased off-plan by investors, and then everybody gets their keys, and some people rent them out, or some people resell. And you will find that maybe some of those that are bought on the secondary market once the property is finished are going to be an end user. So most of the properties in the building, say 70 or 80% of the property of the apartments in that building are occupied by an end user. So there's far less properties available to buy. And also the rents increase in that building simply because there's a lack of supply in a desirable building. So that's a factor that might increase your capital growth.
What are the things that could make your property go down in price?
One of the factors I've seen in the past is certainly the oversupply of a certain type of property in that area is affecting values. If the property is not being well cared for by the property management company or by the developer who's built that property, if it's not being looked after, then that could have a detrimental effect on the property. And if it wasn't built particularly well in the first place, so the maintenance costs are higher in that building. The reputation of that developer has a huge effect on the values or the future values of the property.
What are the due diligence steps investors should take to ensure that they're calculating a realistic ROI?
When you're considering buying a property, it's always a good thing to consider the long-term costs. So that would be, what are the service costs? How much is this going to cost me to manage? What are my management fees? What are my agency fees? How much is a maintenance contract going to cost me on this apartment? Do I need to furnish the apartment to get the best possible rent? I would look at future plans for the community that's surrounding you. I would try and understand what the infrastructure plans are. So the roads, the widening of roads, the added benefit of a metro or water taxes, etc. Is that going to affect your property value?
If someone wanted to learn more about return on investment and how to really calculate a good one for their investment, how can they get in touch with you?
People can get in touch with me via my Instagram, via my website at www.estateagentindubai.com. And I work for a company called House & House, HAUS and HAUS, and you quite often find me on their website. If you need any help with off-plan property in Dubai, please get in touch. All my contact details are in the description below.